Hey everyone, in today's episode, I'll discuss property buying in a recession. It's an interesting topic because everyone would know that we're technically in a GDP per capita recession. However, we're almost in an actual recession in the sense of the actual economy. So last quarter, we actually got a reading of 0.1% GDP growth in total. So we're actually very close, and we're only really being propped up by migration for us not hitting a recession. Look, I'm going to go into a couple of areas in this episode as well. First of all, the definitions. Second of all, how to negate risk in a recession. Third of all, the government's response to recession fears. And then finally, what to buy in a recession. Let's get into it. Let's get into some definitions of what affects a recession. Now, there's a couple I'm going to go into. First of all, what a recession is. Second of all, what a GDP per capita recession is. Third of all, what consumer confidence is. And finally, the effect of a recession. Look, what a recession really is, it's simply a fall in GDP in two successive quarters. Now, the full definition is here from the Oxford Dictionary, but that's the easiest way to describe it. And it has large financial consequences due to obviously people having less money. Look, a key thing that's happened in Australia is we're in a GDP per capita recession. So what does GDP per capita mean? What it basically is an economic metric that breaks down a country's economic output to a per person allocation. Now that's also from the Oxford Dictionary, but to give you an idea, what a GDP per capita recession is whereby an individual's average GDP goes down. Now, that doesn't necessarily mean that the country's GDP has gone down, because you could have, for example, I'd say very large businesses and very wealthy people doing very well, and then you could have the bulk majority of people struggling, and that's exactly what is happening in Australia and a lot of the Western world at the moment. So you have a lot of big businesses just taking over basically the marketplace, and a lot of very wealthy people doing better than ever before, and you have most people that are young or don't own assets that are doing very poorly. So that's exactly what we're in right now, and it's actually a very bad thing for the inequality of a nation and something the government probably should consider. Look, Australia is running so tight, as I said before, so you'll see here, this is just literally off the ABS. So this is what the RBA actually goes off. So I've just taken it straight off their site. You'll see the GDP there. You'll see what we've actually been doing. So we've only grown at 1.1% in the year to March, and we've actually lost 1.3% per capita in terms of GDP there. So there's our GDP recession. You can actually see we're technically in a whole year, not only a 2 quarters of a recession for GDP per capita, actually a whole year, which is really bad. But the government will use whatever they can to try to make it look better. But that's a good measure. You ideally want both of these to be growing at probably somewhere between 2 and 3% ideally. But ideally actually above inflation, so we're actually a net positive in terms of our net wages, should I say. But, they're trying to tax us more at the moment, and then they're not only trying to tax us more, but they're not doing a very good job with the economy. But no one pulls this up, but that's how tight we're actually running. Look, a key part of this as well that does affect, should I say, people's buying and not only buying, but GDP growth is consumer confidence. So a lot of people don't know what it is, but look, what it basically is, and this is just off trading economics, it's a statistical measure of customers' feelings about current and future economic conditions used as an indicator of the overall state of the economy. So the easiest way I can describe that in everyday terms is consumer confidence is simply people's feelings about the present and future economic conditions. That's the easiest way to describe it. And that confidence is what affects basically their spending behavior. So you'll see here, and this is crazy, but we've actually been at a fair low, pretty much a low since the recession we had to have in the early 90s, right, for a longer time than actually the GFC. Now, the media outlets and the government won't say any of this, but we're actually in quite a lull of consumer confidence. I don't actually know many people that are confident about the economy in the short term and even in the nearby future because of a lot of very poor decisions. So just consider that, and that's what really consumer confidence is. Look, another thing about what we need to consider is the effect of a recession. So what really happens in a recession? Now, there's a couple of things that happen. First things first, in a recession, there's immediately less consumer spending. So in a recession, people are generally, I'd say, very, cautious of what they spend on. They generally try to hold their money quite tight. Sometimes you'll even see, like in COVID and some parts of the GFC, people buying, $50 or $100 just worth of flour and yeast because they think it's the Illuminati or they think it's, the end of the world. That can happen. But less consumer spending then leads to a higher unemployment rate. Then due to a higher unemployment rate, you get less business activity because businesses can't service as much without the staff. Then due to that, because they can't service as much and don't have as much activity and people holding on to money a lot tighter, you have lower GDP growth. Then lower GDP growth leads to high insolvency. So first of all, you'll generally see businesses and you'll see falls in the share market quite quickly. That's generally an easy way to know what's coming. You'll see high insolvency, so you get businesses selling up. Then you also get higher forced selling. So not only businesses, but you get people falling behind on mortgages, then forced to sell their homes too. So just consider that in terms of the flow-on effect of a recession. That's generally what happens in the market. Let's get into how to negate risk in a recession. It's probably one of the most important things to consider because during a recession, everyone has heightened tension. The media is going crazy with negative news, and basically everyone around you will say investing or doing anything in terms of spending money is a bad thing to do. I like to say do the pillow test. So that is that if you can't sleep on a pillow at night, do not do what you're going to do. It's as simple as that. But the 4 things I'm going to get into here are 1, holding cash, 2, focusing on needs rather than wants, 3, holding quality assets, and 4, ensuring there is appropriate cash flow for your position. So look, a key thing here is, holding cash during a recession is really important. Now, there's a couple of rules I generally like to live by, or should I say I follow in terms of holding cash, and that's that you generally hold a 10 to 15% emergency fund. So that's a 10 to 15% of your entire, should I say, portfolio value. That generally equals out to about 6 months or so worth of expenses in most cases. In saying that, a lot of people are probably a little more comfortable than less than that, but that's what I like. Generally due to recessions generally being short-lived, due to governance, and I'll get into that in the future, but governments generally, what they'll do is they'll generally prop up the economy in a recession just to make things look a bit better and get us through so they don't get voted out of power. Not only that too, but holding cash in a recession will negate your unemployment risk. So let's say you're a dual income household and you have 2 kids or something like that. If you've got enough cash and someone happens to lose their job, which does tend to happen in recessions, what you'll notice is that you won't be as badly affected and you'll actually still be able to sleep at night, which is good, and probably be okay till you get your next job or your next paycheck if you're self-employed. And the other thing is also that I like to do with holding cash is that it ensures that when the opportunities present themselves, if you can purchase, you'll be able to take advantage of them. So look, it's really important because some of the best, should I say, deals that I've ever seen have come in recessions and times where the market's been down. So definitely consider holding cash in a recession for those reasons. Look, another thing I think people need to consider is you need to focus on your needs rather than your wants. Now, it sounds like something that's very basic and simple, common sense, but people don't think of this stuff, and I'll explain exactly why. Now, if you're in a very up economy and you're doing very well, people might go out 3 times a week for lunch or maybe for dinner. They may weigh you beef for a, Scotch fillet, massage steak or something, that might cost them $150 or something for a night at dinner. But that is more so a want rather than a need. For example, a need is something like filling your car up with fuel because you need your car to get to work. A need might be something like, for example, it could be something as simple as, catching public transport and paying for the fare. That is a need. That is not a want. A want is something like, paying for corporate box tickets at the footy or something like that. You don't literally need that. You only want that. They're two different things. So in a recession or times where things are tough, only spend money and focus on your needs. Do not go through your wants. Do not buy a $20,000 TV that you don't need. Buy a secondhand $500 one if you really need it every night, if you're in a new place or something like that. So just consider that. A lot of people, again, focus on wants rather than needs. Look, another part of what I tend to tell people to do is to hold quality assets. Now, quality assets aren't necessarily just what has the most cash flow, what is in the most expensive location of a city or anything like that. Quality assets are more what performs long term, and also not only that too, but should I say what in downtimes doesn't fall too much. Now, in terms of property, these are houses, and the best regions you'll find are the bulletproof ring of 5 to 10 Ks around CBDs, especially Sydney, Melbourne, and Brisbane. Now, I've previously in other episodes discussed what happened in Brisbane in the 2008 crisis. So I have a lot of friends, and I have one particular good friend that happened to used to sell around Aspley and Stafford, down towards Wavell Heights as well. And he told me that, in that time, you had places like your Hamiltons, Ascots, Albions, Woolowans, that might have fell in 2008 and 2009 by 5 or so percent. Then you had some properties in Logan and Caboolture that sold for literally 40 and 50% below what they sold previously to the GFC. Now, why did that happen? The reason for that was actually because people's superannuation balances tanked in that time. They always do in these times of GFCs and that kind of thing, and all GFC style events or recessions, right? Now, a lot of people there didn't have a lot of money, and they were relying on their super for their future and their future pension to get them through. So what they had to do was they ended up selling their places, and because so many of them didn't have much money, a lot of places flooded the market, which obviously led to an oversupply and not much demand. So people were selling their places to almost next to nothing and then moving to regional Queensland to actually just live their lives on, which is just insane, but people were doing that. Look, those areas aren't the only areas that I'd say to buy, and there's also areas of quality, such as some suburbs in Perth, Geelong, Newcastle, Wollongong, and the Gold Coast. Look, I'd include the Central Coast and Sunshine Coast in that as well, but there's definitely not as many suburbs as in these other sub-regions that I'm giving you. So definitely consider them as well, but follow the demographic trends in the suburbs that are actually gentrifying, because those are the ones that are going to hold through a lot better. And also, not only that too, you're going to have lower vacancy rates in all these suburbs as well. Look, a key part of this too is, obviously cash flow is really important. So you need to ensure that there's appropriate cash flow in your portfolio. Now, what do I mean by that? Look, I generally like leaving a 15% buffer for expenses. So whatever your rent, or should I say repayments are, leave an extra 15% simply on top of that for any changes in expenses that you may have, everyday expenses that are, with that. Because look, everyone would agree with me that just inflation since COVID and the recession of COVID, has gone crazy, and things are literally minimum 15% more expensive, if not more. But if you leave 15% year to year, you'll probably be comfortable. Another thing, lower non-beneficial debt. What I mean by that is if you own both a house and an investment, lower your home debt. Your investment debt is obviously offsettable to your personal income, so that's okay. But if you have a car loan or any personal loan, just pay that off as soon as possible. Do not hold that, because that is just an absolute nightmare to have in terms of recession. If you have offset accounts, load every cent of money that you have spare into that, because it will help you in this time and help you get through. It'll lower your principal balance quicker, so that's really important. And pay all bills on, but not before the due date. So if you have council rates that are due, for example, on the 31st of May, which I did have them, don't get me wrong, late last month, I generally pay things on the last day that it's due. So there's nothing wrong or illegal about doing it on the last day. It's just improving your cash flow, and therefore, you'll have less interest on your mortgage. You'll have more money in time, but just make sure you consider when your bills are due. So just set reminders on your phone, a couple on the day it's due, just to make sure you pay it, so you're not falling behind on anything, and it's not affecting, your credit score or, your credit file or anything like that. But something definitely to consider when you're looking at, recessions and how to negate your risk. Let's get into another section of this video, and that is the government response to recessions. Look, I'm going to get into a few things that governments generally do in this time period, and they are the fall in interest rates, increase in money supply, bailouts and handouts, and increased debt levels. So generally when a recession happens, look, interest rates generally fall fairly fast in this time period. So look, I've just outlined, and this is just from the RBA, the cash rate, what's happened when we've hit recession. So you can clearly see the three I'm just outlining here. We've got the recession we had to have, the GFC, then you've also got the COVID 2020 pandemic. So you can see what generally happens in this time period is that governments, because they want to stimulate the economy, interest rates generally fall fairly fast. So in a previous episode, I did discuss this, and I said interest rates generally only come down when the economy is fairly bad. So this is a perfect example of it. When the economy has gone bad, generally the cash rate comes down because they want to increase money in the actual market to increase consumer sentiment and spending. So that's what they generally do in times of a recession. Look, another thing here is, a lot of governments tend to give bailouts and handouts. And now, look, my personal opinion on this is they do have to a level, but they generally overdo it. And I don't think anyone would disagree with me that in COVID, they definitely gave out too much money, and we're definitely paying for it now in terms of inflation. But here's an example of this is literally off a government website. You can clearly see here the program this is May 2020, cost Australian government $44 billion US dollars for obviously subsidies for businesses and also per people as well. So that's generally what they do in terms of handouts and bailouts, which isn't really good. I've got another graph here. This is actually from the RBA. With sources from the ABS, Treasury and state territory budgets. So you see here all the stimulus that's basically been given out in the budget. So you can see we've really been running at a deficit for a long time, and it's only really been propped up by pretty much, immigration, and that's really it. But you'll see right now the deficits that we're running at, employment, subsidies there, other stimuluses as well. You can see in that COVID time, just ridiculous how much debt we went into. That's what they do. You can see there straight after the 2008 crisis there as well, how much debt we'd been in as well. But most of that, however, was existing deficits and then state and territory government deficits. But in that COVID period, a lot of that was personal and business deficits. So that's what governments generally do. Due to running a lot of handouts and bailouts, what generally happens then is there's an increase in money supply. So you'll see here again, probably one you'd probably want to look at is the broad money line. So it's that sort of darker line there. You'll see after basically interest rates have dropped, especially in probably I'd say the preceding probably 6 months to a year, you'll see that broad money supply has gone up. Obviously, the credit number is a little bit slower. But the reason for that is because once interest rates drop and lending is more promoted, particularly when you have quantitative easing, especially like in the 2020 cycle, what you'll see is that governments increase money supply, therefore money supply increases confidence, and money's just floating around the economy a lot more. So that's what happens when they do that, and that's what they generally do. Now, it's not good for inflation, but it's still what they tend to do. Look, again, I'll say that they do need to do it, but it's the level that they do it at that's always, in my opinion, like hyperbolic to an extent. So they probably should do it at a little bit lower level, as unpopular as it may be politically. In my opinion, if you're a politician, you need to do the right thing rather than just what everyone feels like you should do. Not only that, you have an increase in debt levels. So look, I've used this graph previously, and I can't exactly put a graph together for the Australian one because the numbers are a little bit complicated as to how it comes out from RBA and ABS data. But it's almost, I'd say, exactly correlated to the US, and you can see just here what's going on in almost every decade. You'll see that basically any time a key recessions happened, like in the early 90s, you can see the supply of money go up. Then you can also see in 2008 just go hyperbolic again. And if this goes right through to 2024, like today, you'd see in the 2020 to 2022 period, it went up again at a massively ridiculous level. So that's what the governments generally do in response to a recession. So look, all of those things together, what I'd say is they're not ideally the best things they should do. They do need to do them, but it's the levels to what they do them. They always overdo it every single time. So look, when interest rates go up, I think they usually overdo it as well. When they go down, they overdo it, but to a ridiculous level. When it comes to money supply and money printing and debt levels, they overdo that even to a worse level. So just think of that with what the government does. So that directly really flows into asset prices. What to buy in a recession? Look, generally due to a massive increase in money supply, and not only money supply, but also debt levels, I'm going to get into a couple of things. So first things first, the incredible opportunities that recessions represent. Second of all, assessing your risk appetite and tolerance. Third of all, the focus on long-term fundamentals. And finally, what to purchase. Look, over the time of recessions, there's been some incredible opportunities that have presented themselves in terms of buying opportunities in property. So I'm going to get into a couple in a few different states. So I'm just going to do your standard New South Wales, Victoria and Queensland opportunities that have presented themselves. So here's an example of in Newcastle in 2008 and 2009, at the time of the GFC, in a suburb called Carrington. Now, you'll see here in 2009, I've done this in one of the more popular streets, so the data's fairly accurate. You'll see that there were opportunities sub $300,000 in Carrington in 2009, and then right up in 2022, they were selling for 850 odd thousand. So, in that time alone, and that's only 13 years, people have almost tripled their money, basically tripled their money. So that's an opportunity that was available in the GFC, and that's some opportunities that are available in recessions and GFC style events. Look, in Victoria, it's probably even more ridiculous. Here's an example of recession deals in the GFC as well, in a suburb called Williamstown, which happens to be just on the western side of Port Phillip Bay of Melbourne. So you'll see here in 2008 and 2009, you could have picked up a place around that $600,000 mark in Williamstown. And then you'll notice that not only that, then you had places in the last 2 years or so selling close to that $2 million mark. So there's people that are literally more than tripled their money in that time just from buying correctly. To give everyone an idea, the street I've actually used a better pocket in the 2008 time than the actual 2022 and 2024 time. So that's probably even made it look not as good as it was, but that's the opportunities that are available in the GFC in Williamstown. Look, at the same time as well, in Queensland, you had some unbelievable opportunities. So I'm just showing you a suburb here called Camp Hill. It's in the inner east of Brisbane. So in the GFC, you had property selling literally for around that $500,000 mark in the GFC in 2008 and 2009. Now they're selling for about $1.5 million. Now, obviously, there's one that's 1.22 and 1.775 million, but the median price of Camp Hill is about 1.5 million. So they've also roughly tripled in the same amount of time, and that's about 15 years. So not too bad in that, and you'd be pretty happy if you bought in that GFC time, I'm sure. So that's some of the opportunities that recessions and GFC style events happen to present. So it's probably the best time you'll ever take advantage of them, in my view. Look, a key part of buying something in a recession is managing both your risk appetite and your tolerance. Now, I've covered this in previous episodes, but look, your risk appetite is basically the risk you're willing to take on, and the tolerance of risk is basically how willing you are to manage the risk. So in property, risk appetite is generally or genuinely, should I say, it all comes down to buying, like how high you're willing to buy, how in most cases how much money or capital are you willing to put up front to purchase a property. And tolerance is when you have the property, how much money you're willing to contribute to it, or what return are you kind of looking for, happy to tolerate in terms of sustaining or maintaining your property portfolio. So that's what they both kind of mean when we're talking about risk appetite and tolerance. Really, really important in a recession because it's a time of heightened emotions. So just consider that when buying in a recession. Look, not only that too, I think a really important thing here as well is we need to focus on long-term fundamentals in a recession. So look, it's very easy to go short-term and say, this asset has really high cash flow, so I'm just going to buy it, but it might be in Broken Hill, it might be in Tennant Creek or in the middle of basically nowhere, it might be in Mount Isa, and don't get me wrong, the tenant's basically paying your whole mortgage for you, but it's worth the same today as it is in 15 years, so why would you buy it? But what you really need to do is focus on areas that have performed very well long-term and will continue to do so in the future. So again, I've gone to fundamentals before, and you can search up on my page on what the fundamentals are, but it's mostly demographics, where all the jobs are, lifestyle triangle, and also not only that too, but also where all the continual economy and jobs are and the best jobs are. So that's where people like to live, that generally sit in the inner suburbs of CBDs, particularly family suburbs close to the CBD. So look, a suburb that I'm just going to show everyone here is a suburb called Grange in Brisbane. So it's a part of the inner north region of Brisbane. And you'll see, look, I've used a street here just off Domain to demonstrate how much it's grown. But you'll see here in basically at the turn of 1980, you could have purchased a place for about $30,000 there. And now, they're about 1.75 to 1.8 million as an average in this street. But that's what happens year to year to year. So that's, look, literally in like around 40 to 43 years there, depending on which property you look at. You're looking at about 50 to 60xing your money, which is just absolute insanity there. But that's literally what can happen if you buy it correctly. So in this time, you've had the stock market crash of 87. You've had the recession we had to have in the 90s. You've had the dot-com bubble. You've had also the GFC. You've had the Royal Commission and lending restrictions that come in 2018. You've had the COVID-19 pandemic. And this is still done 50 to 60x. So this is what you need to do when you're considering buying a place for long-term fundamentals, because this is what can happen. And to give everyone an idea, somewhere like Logan was priced at the same price as somewhere like Grange in the early 80s. Actually, it was even, to an extent, depending on what graph you look at, almost slightly more expensive. And now that's only like $500,000 to $600,000, a third of the price of it. So look, again, as I'll say, buy in suburbs that perform well long-term, because they are always going to do a lot better in terms of performance. So just consider that when you're buying. Probably everyone's biggest question in this video would be what to purchase during a recession. And I'm going to get into that right now. So it'll be no secret to everyone here that I'm definitely a fan of diversified economies. And the reason you purchase in diversified economies is for a few reasons. First of all, they recover significantly stronger. Look, if you have an economy that's well diversified in terms of, should I say, it's got multiple industries for it, what will happen is you might have one or two industries that are really badly affected, but not all industries will be badly affected. Now, the reason why Sydney and Melbourne perform best out of the GFC is because they're the best, should I say, performing economies and the best also diversified economies. That's why. Whereas you had somewhere like Perth and Brisbane that did perform but not very well, and they went quiet for quite a long time. And the reason being for that is because the economies aren't as well diversified as Sydney and Melbourne. Now, as sad as it sounds as well, look, the governments really only tend to spend money in these well-diversified economies. So they probably shouldn't do that, but they tend to basically throw all the money at the cities and where all the money also is and the actual wealth is in the market. Now, not only that too, but these markets generally are home to a higher level of equity in the markets, generally because you've got longer term residents that reside here. And that's because of obviously jobs, school zones, facilities, and great lifestyle precincts that have everything near them. So even elderly residents, a lot of them will happily stay in areas where there's good, care, there's good hospitals, there's good specialists around, and that's what also why you purchase in diversified economies, because those people don't sell, and often they don't have much mortgage left, or sometimes own their house completely outright, particularly in your best suburbs of Sydney, Melbourne, Brisbane and Perth. Now, look, not only that too, but their growth cycle will actually start well before less diversified markets. And the reason being is because it's a flow-on effect. Because if you have a city that has a well-diversified economy, you might have industry that is affected, but because all the other industries will start going earlier than a less diversified economy, what will happen is slowly money will be spent in, comparative or competing industries of them, which will then flood money into their market. So that'll start to happen. You might, for example, have a construction shortage, right, in one period of time, but you might have, for example, the banking going very well in Melbourne. Now, if banking is going well, that would mean finance is going well, which means money will start to be spent in property and probably construction, which will then pick up the industry. Whereas if you've got something like mining, for example, and that's entirely based, a city or region that's entirely based on mining, like your Pilbara, and that's shot, you don't really have anything else to pick it up in the region until the whole economy picks back up. You don't have really many competing things that can actually pick it up in the same region. So that's something to consider as well. Finally, in diversified economies, look, growth is more exponential. And then what I mean by that is I don't mean necessarily that it goes up exponentially at the craziest top performing levels year on year that breaks the record for the best performing suburb of the year, but they perform very strongly consistently. Now, your best suburbs will often show up in your reports over the long term. However, they often aren't your number one performing suburb in any given year. And the reason for that is because they're very consistent in nature in the way they perform. And when they go down, they don't go down by much. Whereas you'll get somewhere like in Logan, in a GSC style event, that might go down by 30 or 40% and then pop straight back up by 30 or 40%, which, don't get me wrong, it might be a very good, short-term buy, but in the long term it's not. Whereas you'll get somewhere like Bronte in Sydney that in the terms of a recession, it might only go down by 5 or 10%, then it'll pop up by 15 or 20% the next year. So it won't show up in the media, but it will actually show up in the long-term averages, because then for the 3 years preceding that, it'll do 10%, whereas somewhere like Logan, in most circumstances, might only do 2 to 5%. So it's actually grown more than your, record setter of a single year, but it won't show up in those single year reports. So that's the thing to consider, especially in diversified economies. They won't set the world alight, but they're going to do very well over the long term, and that's what's going to actually make you a lot of money and wealth in the long term and give you that freedom you're after. Look, another thing is purchase in strong demographic markets. Now, this is just from Microburbs, a graph of average median household income. And you'll see in Brisbane, I've said this in previous episodes, so for those that haven't seen them, go and have a look at it. Look, your Brisbane is mainly your 10K ring around the CBD. You've obviously got Fig Tree, Pocket and Chandler that I'd say are probably anomalies, where you do have quite a few wealthy business owners and particularly politicians living there. But mainly in Brisbane, your 10K ring around the city is where all the money is. So these are the best performing markets, and they perform similarly to Sydney and Melbourne. So if you're looking somewhere like Sydney or Melbourne, purchase Brisbane and also Perth, purchase in your strong demographic markets. So especially in Sydney, you've got your lower North Shore, inner west and eastern suburbs. In Melbourne, you've got your inner west, you've got your inner city, inner east, inner southeast and Bayside. They're your best markets, and they're basically your top performing markets in terms of capital growth as well. So consider that when buying in terms of a recession. Look, always purchase houses, never purchase a unit. It's as simple as that. Look, again, as I said, look, the only suburbs I'd really purchase a unit in are suburbs where the house price is probably like $3 million and a unit's $1 million. But in saying that, I still wouldn't purchase a unit because I could just purchase in a different city and get a detached dwelling with better capital growth, and I can actually do a lot more to the dwelling rather than a unit. So never purchase a unit. And this is just off your CoreLogic 30-year report. You can clearly see here that in both capital cities and regionals, houses have pretty much outperformed units in every measure. Even regional houses, which includes places like Broken Hill that are absolutely rubbish, have still outperformed units. So in other words, just never purchase a unit. They just suck. Don't do that. Anyone who tells you to buy a unit, really, just don't do it. Purchase houses only, really. Look, finally, consider cash flow when you're buying versus your income. So look, high cash flow will decrease risk. It'll also ensure that you have appropriate buffer. You'll be able to also capitalize on purchasing quality rather than quantity in a lot of circumstances. So what I mean by that, though, is when I say capitalize on purchasing quality rather than quantity, what I mean is don't focus on something that's purely cash flow and no capital growth. Focus on capital growth first and then cash flow second, because capital growth is really important because cash flow is a representation of your asset value. So your yield is the yield or percentage of your asset value. But when you go to buy, if you have the same suburb in terms of capital growth and you have one yielding 3%, another 4%, buy the 4% one in almost all circumstances, actually, buy the 4% one, but particularly in a recession, buy the 4% one. Now, finally, in this actual example I'm giving you here of what I would do is I say do not fall for the cheap trap. And the reason I say that is because there's a long-term saying in property, and that is cheap today, cheap tomorrow. There's a reason why it's cheap. If it's cheap, it's probably not good performing, because if it's good performing, it wouldn't be cheap. The only reason it could be cheap and high performing is two reasons. And that is that it started at a significantly lower price point than your more expensive suburbs, or it's gone through or going through gentrification at the moment. Now, just make sure if you're doing that, you know what gentrification is. It's not as simple as, should I say, the suburb looking better. That's rejuvenation. Gentrification is when a suburb has wealthier people moving into the suburb and it changes the whole demographics of the suburb. That's the key thing. But for that to be sustained, it needs to have good jobs, good access to the CBD, good access to lifestyle facilities, good schools, a low supply combined with an excess demand from a wealthy demographic. Those are all things that need to happen for gentrification. So you'll see people saying, for example, oh, Shepparton's cheap and it's gentrifying, but no wealthy person wants to live in Shepparton. Sorry, I mean it the best way. I like the town. It's a beautiful town to visit, but in terms of investing, just don't buy there. It just doesn't make sense. Buy in an area that's actually going to gentrify. So consider that when you're buying. That's what you'd buy. So to put it very simply, buy houses in well-diversified economies that are in wealthy demographic areas and that have a fairly good cash flow for the price you're buying in. Don't buy cheap, because cheap today, cheap tomorrow. It's as simple as that, and I really thank you for watching. Thanks so much for watching. Please subscribe to the channel, and if you're looking for a buyer's agent in Australia's best performing suburbs, be sure to reach out via www.compoundinvest.com.au. Thanks again, and welcome to the channel. I'll see you on the next one.